Hi everyone, welcome back to another episode of the Aussie Dividend Machine. Thanks for joining me guys. Today I'd like to give you an update on my ASX portfolio. A number of you may have been wondering what that number in the top left-hand corner of my thumbnails is. That's the current value of my portfolio. I've started a brand new portfolio just for this channel. This is the portfolio I'm going to be concentrating on going forward. In this video, I wanted to give you an overview of my portfolio and go over each stock I currently own and why I purchased them. I hope you guys enjoy this video. I'll be making one of these portfolio updates every single week. I'll also let you guys know whether or not I'm going to buy more, hold the stocks I've got, or potentially sell them down the track. And guys, if you've got any questions, especially about the stocks that I'm talking about in this video, make sure to leave a comment down below. More than happy to answer any of your questions that might come up. Don't forget, if you like the video, to give it a big thumbs up. And if you want to see more videos just like this, make sure to hit that subscribe button as well. Without further ado, let's get straight into it. So guys, this is my portfolio. This is on the InvestSmart website. InvestSmart has a really good platform under the My Portfolio section. It's a free service. I think InvestSmart sell a lot of managed financial products. You can subscribe to their Intelligent Investor. Not something I do. I just use their free My Portfolio because I think it's a great visual tool to have a look at your purchases and also dividends coming in. You can see down below on this line, each of the little letter B's is when I purchased a stock or bought a stock. You can see the quantity I've bought, the ticker or stock code, and also the price I paid. These little flags come up, they're the dividends that have been paid. So here's a dividend from NIB. I didn't receive this dividend because the ex-dividend date was before I actually purchased the share. Still shows it there, but doesn't actually count. When you do have dividends come in, this website can generate a dividend summary to see exactly how many dividends you've been paid in a given amount of time. It's a really neat feature, but I like seeing the little flags pop up along the way. So I've started a fresh portfolio, and this is what I'll be concentrating all my efforts into from now on and sharing it weekly with you guys. I think it's important that you see that the advice I'm giving, I'm actually backing up with purchases. I think it's interesting to see what I'm buying, maybe where I'm going wrong, where I'm going right. I want to be open and honest and share with you guys every step of the way. I'll take you through my purchases now. I won't go into too much detail. There's a couple of articles I wanted to touch on as well that relate to some of these purchases. So NHF or NIB Group, as they're called, is my private health insurance. In Australia, private health insurance is pretty common. It's supplementary to the public health scheme, Medicare. So it's great for extras cover, which is what I've got. NIB is fairly profitable. They've got good financials. They pay a decent dividend. I thought they were a pretty solid buy. No real story around purchasing them. Maybe we'll look into that stock in the future. The other first purchase I made was SCP, or Shopping Centres Australia. This company owns a whole host of small shopping centres all around Australia, usually with one or two major tenants, which are normally supermarkets. And then they have some specialty stores around those supermarkets. They're not big plazas or shopping malls. They're just quite small community style supermarkets or shopping centres. The reason I like this stock is because it's a really solid defensive stock. Their tenants, Woolworths, Coles, other major supermarkets, even in times of hardship, their revenue stays consistent. They're long-term tenants. They've got 12, 13, 14-year leases. And this means that, in times of hardship, there's just no fluctuation in the dividends that this company pays. The reason I purchased them is because at the moment their stock price is really low. It's dropped off a cliff after coronavirus and hasn't really recovered, which is surprising. It'll be interesting to see their half-year profits or revenues, and we'll see what impact it's actually had. But I think this stock's solid, and I really like their tenants. I can't see any reason why it would go south in the future. Next one along is TCL, which is Transurban Group. Transurban, as I've spoken about in a few of my older videos, they're a major infrastructure company. They're a developer. They don't build the projects, but they usually partner with governments in PPP type arrangements to build critical infrastructure. Transurban will provide some of the funding, and then there'll be a toll arrangement on those roads. So essentially the Transurban benefits after the fact. Once the project's built for the next 20, 30 years, however long the term of the contract is, they'll receive tolls from the use of the road. So it's in their interest to build a good road, a road that will be used, and the more it's used, the more they benefit. They've got a couple of really big projects going on in Melbourne and Sydney at the moment. They also have projects in the US and in Canada. The reason I made a purchase here, I'll go up to this article here from the Financial Review. In the project they're currently doing in Melbourne, the builder has encountered some contaminated soil, and quite a lot of it, an unexpected amount. Contaminated soil is extremely expensive to remove from a project because of how it has to be treated. The quantity of soil is so much that it's actually put the project's viability on the line. The builder doesn't want to proceed any further because there's such a big financial risk, and Transurban's firm position is that it's not their problem, it's the builder's problem. The government is the third party to this dispute. For a long time they've been saying it's not our problem, you two need to sort it out. Until recently they've been brought into the dispute. The courts have ruled, yes, you also need to be involved. And surprisingly, shortly after this happened, new Victorian regulations have come into place which change how this type of soil can be handled, and it influences the cost of its disposal. So now it's actually reduced the cost, surprise, surprise, and the issue that once was is no longer as extreme or as potentially financially destructive to Transurban's builder. So as soon as I saw this, bang, jumped on Transurban because I think this was a big risk for them. It might have led to a drop in their share price, and I don't think that's going to happen anymore. I was sort of waiting for that, but not after that advice. So I'll show you the project. Here it is, the Westgate. There's a tunnel and extension of a freeway, massive project. And obviously here along this line is where all this contaminated soil is. Back to the portfolio, and my next purchase is BPT. I've been over Beach in another video, so you can go back to that video. I'll put a link up on the screen now. You can check out Beach in that video. I won't go into it now. That was pretty in-depth, so check that out if you want to know more about Beach Petroleum. There's the NIB dividend. Thanks, NIB. Next is Crown. So Crown own and operate hotels and casinos. They've got some big operations in Melbourne, and they're currently building a massive tower in Sydney. I've got some photos of that here. $2.2 billion investment. They've got top of the line restaurants. It's high-end luxury hotel. There's a casino. All these things that generally generate a lot of money. Obviously now with coronavirus, the perception of how valuable this investment is has taken a nosedive. People are wondering when we'll come out of lockdown, when we'll be able to use these services to their full potential again, if ever. So as a result, Crown's share price has just stayed stagnant after its major drop at the peak of coronavirus, just like almost every other stock in the market. So I thought it was a good time to purchase. They still have good revenue. They've got a high profit margin. They pay a consistent dividend. And I think even with an investment like this, if it's not 100% utilized, it'll still generate some great returns going into the future. That's my purchase of Crown. Watch this space. I reckon they might be worth another purchase coming up. And finally, my most recent purchase is Goodman Group, or GMG. I like GMG. I've liked them for a while. They're a property developer. They specialize in industrial property, so warehouses, distribution centers. GMG and Brickworks, which is a construction materials company, they've recently paired together and signed up Amazon.
As you may know, Amazon does not purchase or build any of its own warehouses. They exclusively lease their distribution spaces. This means that all these real estate companies in Australia and the US who specialize in industrial assets some of them have been lucky enough to get Amazon as a tenant. And we all know the success story that is Amazon and how rapid their growth has been. Well, turns out to fuel this growth, you also need to lease warehouses. Talks about how they've signed up Amazon, how they've also got other major partners such as Coles, which is a massive shopping centre in Australia. They're looking good, but how good are they looking? I found a Forbes article here. Talks about some of the companies in the US that have had the same success. And you look at a company like Duke Realty. When they signed up Amazon, they were trading at something like $15 a share or $18 a share. 5 years later, they're trading at $40 a share. We're looking at doubling in growth. So if Goodman is anything like Duke or any of these other real estate companies listed here, they're going to see huge growth as a result of signing up Amazon. Amazon's only just getting started in Australia. Their operations are rapidly ramping up. I'm subscribed to Amazon Prime. I love the service. I think they're going to do really well. So I can't see Goodman going backwards. I'm definitely keen to get more of their shares under my belt as soon as I can afford it. I think they're a great company and I think they're going to go from strength to strength. So that wraps up the purchases I've made to date. As I said, I'll keep you guys updated weekly as we go. Got my tax return coming in soon, so that'll be a good boost. Get a couple more grand into this portfolio and slowly just chip away every week, see if I can make a regular purchase and grow this portfolio with you guys. If you got any suggestions, comments, make sure you leave them down below. It's just one more article I'd like to touch on. I saw published on news.com.au. It's titled China Trade War, Why Iron Ore Industry is Australia's Trump Card. If you have a look at my South China Sea video, you'll know that I mentioned I thought iron ore stocks, Australian iron ore stocks, may have been a risk investment due to the current situation in the South China Sea. Now, I'm taking that back a little bit because of this article. It talks about China's reliance on Australian iron ore. This is not an export that China can afford to play around with. You can see by this graph, Australia provides the vast majority of iron ore to China. If China were to damage this relationship or increase the price that it costs its people to bring in Australian iron ore, they really would be shooting themselves in the foot. They're going through an economic hard time at the moment, and they're relying, as they normally do, on infrastructure spending to get them out of the hole, just like a lot of countries are. And to build structures and roads and buildings, you need steel. To make steel, you need iron ore. And so they are going to be reliant on Australian iron ore. I did notice, however, they've got a major stake in Rio Tinto, which is one of Australia's biggest miners. And they're looking at trying to partner with Rio Tinto to build a mine not in Australia. I believe it's in Africa, and it's a huge known iron ore reserve, but it just hasn't been exploited yet. If that gets off the ground, mind you, it would take a number of years, then perhaps you could see iron ore being more of a risk, but I think at the moment it's just not a risk. I take back what I said. Once that iron ore price drops, I'll definitely be looking at BHP and Rio Tinto stocks. So that brings it to a wrap, guys. Hope you enjoyed that overview and stay tuned for the same video next week.
Well, guys, thanks for watching. I really enjoyed making that video. I hope you liked it too. If you guys are keen to see more of this content, make sure to hit the subscribe button and help support the channel.